More on Treasury yields in the markets in the second half. Let's bring in Chris Bitterly, head of investments at Citi Global Wealth. Chris, great to have you with us.
Great to see you. Thank you so much.
We've seen today stocks really do nothing in reaction to the rise in yields we saw, at least for today, Chris. And so I'm wondering if, as long as we stay in a range, if it matters to how stocks perform in your view.
Well, look, I think stocks have performed really well, even with all the volatility that we've seen in rates. The market where we've seen the most volatility is on the rate side, and just the repricing that we've seen in rate cuts from the beginning of the year to where we're at now, around 2 rate cuts by the end of this year. But I think the important thing is, this is the question that we're receiving from so many investors, is that, given the fact that we have these indices hitting all-time highs, should I stay invested? And this is where I think the hedging conversation is so important, because we actually believe that we're going to see a broadening out of earnings. We had 7 out of 11 sectors in Q4 of last year that were in earnings recession. We anticipate that we're going to see 10 out of 11 sectors seeing earnings growth by the end of this year. So we want to make sure that investors are taking advantage of the tools to stay confidently invested.
So when you're talking about hedging, are you recommending the hedging, or are your clients wanting to hedge going into second half?
We're recommending the hedging, and it's really in response to what we're seeing from investors is this idea that I'm either all in or all out. I'm either all in on the Mag 7, or I'm rebalancing entirely, or I'm all in on US equities, or I'm shifting into cash. And so really, we're recommending hedging just because volatility has been so muted. So when we look at volatility, particularly at the index level, so looking at the VIX as a proxy, it's been relatively muted. And what that means is that some of these hedging strategies are also relatively cheap. So if you're worried about whether the earnings growth story can continue, you're worried about the outcome of the election, you're worried about continued geopolitical tensions, this is an effective way to kind of get you through the next couple of months and maintain that exposure, for which we think is actually a constructive environment for risk assets.
Chris, it's Karen. I agree fully on the cheap protection right now, but I'm curious, did this phenomenon of your clients wanting to be either all in or all out, has that been a good barometer of anything in the past?
I think it's just kind of human nature in terms of some of the questions. As you have markets hitting all-time highs, there is always a question of, should I take some of the gains off the table? I think the challenge for it, though, particularly for U.S. investors, is there are a number of different dynamics that come into play that could also make people relatively create some inertia. So, for example, the tax impact of rebalancing and what that means. And so that's why I do think these types of strategies become particularly useful when you're weighing some of those cost benefits of what it would actually cost in terms of broadening out exposure, which we've been recommending.